For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. I want to tell you two things about management. Two more that we've been talking about management. Here's two more things. Companies don't change their worldviews. Don't look for companies that change their worldviews. Companies may even hire outside consultants to tell them something new, but they won't listen unless they already agree with them in the first place. Hiring, mentoring, promoting, modeling behavior all reinforce a company's worldview. Apple is about the only example of a large company changing its worldview, and even there, the change was partial. They fired a lot of people and brought in a whole lot of new executives, and still they didn't change everything. Companies don't change their worldview or culture, and there's the cockroach theory. This usually applies to accounting errors. So meaning if you see an accounting error that makes things look better than they actually are, that like if you see a cockroach in the kitchen, there's going to be more cockroaches. You're probably going to find more of these errors. Well, that same sort of thing, you actually can apply that to a company. If you have an experience with a company, even a large company, you can extrapolate a little bit about that company's values or culture. If you have a good experience with a company or a bad experience with a company, you actually can extrapolate a little bit about that company's culture and values. Okay, so because of the reinforcing phenomena of hiring, mentoring, promoting, and modeling behavior, companies don't change their worldviews or culture. They actually become more like themselves over time, okay? So you get all that. They only hire the people that see things that way. They only promote people that see things their way. They only mentor people that see things that way. You get all that. Okay, so that's the first thing. Companies don't change their worldviews. The second thing I want to say about management is that there's operations and there's capital allocation. So there's operations, meaning how do you run a business, okie dokie, and then there's capital allocation, meaning what do you do with the profits. That, of course, is very, very important. So here might be the first three things that management maybe should do with their profits. Do they sink the profits back into the business in a way that gets a good return on the money? Or instead, are they keen enough to know when money would be better spent buying back stock? Okay, so that's the second thing, buy back stock. The third thing, do they pay dividends when the money can't be spent well in the business and it is not an advantage time to buy back stock? Okay, so this capital allocation is what Berkshire Hathaway is all about. Warren Buffett does not meddle in his managers running their businesses, but he does not let them allocate capital. That's his job. And he has shown the best record probably ever of allocating capital well. And that's why Berkshire Hathaway is so successful. Okay? And then another thing you can do instead of investing in your own current business, instead of buying back stock, instead of paying a dividend, you could do an acquisition. Thing is, acquisitions usually don't work. At least they don't work as well as they are billed when they are consummated. A good acquisition comes at the right price and integrates well with the current business. And integrating the two businesses together is usually more difficult than planned because of cultural and technological differences. In sports, sometimes you see the most notable and celebrated coaches taking on a player that might be considered a problem player, and the coach might be thinking, I can fix this guy. And CEOs are kind of like coaches. They're not lacking in self-confidence, and sometimes maybe they do acquisitions that they imagine are going to go better when they do them, and then they don't. Okay, so management has to take care of operations as well as allocate capital. You like a management team that shows when it invests in the business, it gets a better return than it would have if it would have bought back stock or paid a dividend. And acquisitions generally don't work. So look for a solid record of making acquisitions that do work or just not making acquisitions at all. Okay, so companies don't change their stripes. When evaluating management, you want to make sure that they're good stewards of your capital. Companies don't change their stripes, their worldview, their culture. When evaluating management, don't just look at operations like, hey, this person knows about the oil field business or whatever. Look at how they allocate capital. Do they only sink it back into the business when it's going to get a good return? Do they buy back stock at the right time? Companies are notorious for buying back stock when it's at the top. And if there's neither of those two things, will they pay a dividend? That's a great thing to do with cash as well. And then are they judicious about their acquisitions? Okay. I hope you found that helpful. I'm Joe Springer for the Wall Street Exclusive, helping you make informed decisions so you can succeed in the market. Coming up next, we're going to go to the laboratory and learn about biotechs. For the Wall Street Exclusive, I'm Dr. Joe from the Wall Street Exclusive Institute in Geneva and Vienna and Zurich. And I'm here to give you a biotech primer. So here's the 10 steps that biotechs generally go through. Okay, so biotechs have a lot of upside because they have sustainable, the right ones have sustainable competitive advantages. We talked about Tonix and Zeltiq and Mankind and Puma and Celgene and Jazz and Amicus and Second Sight if you've read my stuff. Biotech, a lot of upside in all those. Biotech has everything you want as far as upside that is yet to be unearthed. Some of tomorrow's winners are always biotechs. And remember, nobody is born knowing about biotechs. No one is born knowing this stuff. Everybody that knows about biotechs learned it. And you have the internet. So embrace the trapezoid of research, and I'm going to help you here learn about biotechs, and eschew the circle of competence. You can learn about biotechs. Okay, another great thing about learning about biotechs is that there's cumulative knowledge. If you research one biotech, it's maybe kind of hard, but the next one's a little bit easier, next one's a little bit easier. You learn more and more, and you get better and better. Okay, and another great thing, another reason to learn about biotechs is this might be the best time ever for biotechs because big pharma's old model of doing the research for the drugs themselves is basically broken. If they don't get it right, the costs can eat up all of their profits, and it makes these steady businesses kind of risky. They would rather have the little guys develop them and then buy them up. Okay, so generally the 10 steps of a biotech goes like this. Number 1 is the theory of a drug's benefits. Hey, this might work. Okay, so that's how it starts. Number 2 is preclinical testing. That means testing in the laboratory and testing in animals, and hopefully ethically testing in animals. Number 3, the company submits an IND, an investigational new drug application, proposing human testing, and that's called clinical trials. When they do human testing, it's clinical. When it's lab and animal, it's preclinical. Okay, and step 4 is you do a small phase 1 study in humans, and you're looking for the safety. Is this safe? And then number 5 is you do larger phase 2 study or studies looking for safety and efficacy. And step 6 is you do a larger phase 3 study or studies, again looking for safety and efficacy. And then number 7 is you submit your new drug application, your NDA, you submit that to the FDA. If your drug is a biologic, you submit a biologics license application, a BLA. If your drug is a generic, you submit an abbreviated new drug application, an ANDA. Okay, so that's step 7. Step 8 is the FDA reviews the drug. FDA reviews your application. The FDA reviews the drug's safety and effectiveness based on the trials. It looks at the trials you ran. It looks at the label. The label's the important information that comes with the drug describing how to use that drug and if there's any warnings, things like that. And then also, the FDA is also going to, very importantly, inspect the manufacturing facilities. Is this going to be made in a clinical place? Is this drug going to be made in a responsible clinical place? And then number 9, they're either going to approve your drug or give you a complete response letter saying, here's why we didn't approve it. And then step 10 is you market the drug, okay? So number 1 is the theory, hey, I have an idea, this might work. Number 2, preclinical testing, animals and lab. Number 3, submission of an IND, we want to test this in humans. Number 4, a small phase 1 study or studies in humans. Number 5, larger phase 2 study or studies of safety and efficacy. Number 6, larger phase 3 studies or studies for safety and efficacy again. Number 7 was the submission of the NDA to the FDA, the new drug application. Number 8 was the FDA review. Number 9 was the approval or complete response letter. And number 10 is you take the drug to market. Okay? So biotechs there is a learning curve with biotechs, but once you learn it, the next biotech you learn about, you have a step ahead of everybody else. So once you get good at biotechs, there's a nice little niche. You know, if you've looked into stocks, you see a lot of articles about biotechs. People get very excited about biotechs. They go way up, they go way down. There's a lot of money to be made in biotechs, and it's got a big learning curve. So I hope that you found this helpful to start your learning in biotechs. Great industry that should be here for a long time, great sustainable competitive advantages. And I hope you found that helpful. I'm Dr. Joe from the Wall Street Exclusive Laboratory, helping you make informed decisions so you can succeed in the market. Coming up next, we have the first ever Thunder Angle. For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. Let's do the Thunder Angle. Now, Jim Cramer does the lightning round. That's capricious and arbitrary. Here we do the Thunder Angle. It's mature and important. Genoa asks about Zogenix. Zogenix, ZGNX. It's a biotech. It's a pharmaceutical company kind of like tonics. They're going after central nervous system disorders, pain. What they're doing is they're combating opioid abuse, and their drug may help with opioid abuse. Zogenix is further along than tonics is. They're actually on the market. They're also valued at 2.5 times tonics value. I don't mind Zogenix at all. You have my blessing if you like it. It does not have the very high upside of tonics, and it's valued more than tonics, but it's farther along. If you like it, that doesn't look like a bad one to me. I give you my blessing. Okay, Alex asks about BlackBerry. BlackBerry, you've heard of BlackBerry. There's a device company. They lose money. They're a $6 billion market cap. So they have $6 billion to lose. It's a tough business, devices, even if they do temporarily hit pay dirt. If you want to be in the device business, I prefer Apple, or I'll send you to TelcoNet if you want to be in the hardware type stuff that has a moat. So I don't think BlackBerry is a very good buy. Buy TelcoNet, there's a great buy. Mary asks about Microsoft. Well, Microsoft's got that international exposure like a lot of these big companies do. They need growth to make up for their shrink. Their operating systems business is shrinking, all that stuff. I prefer Facebook if you want a large tech software services type of company. They got the growth. But you might like Microsoft, Mary, because of the dividend. So I'm going to send you the Compass Minerals, CMP. Compass Minerals, you know what they're going to be doing in 20 years. If somebody tells you they know what Microsoft's going to be doing in 20 years, you have my permission to slap them and tell them that Joe sent you. Compass Minerals is still going to be selling salt in 20 years, and that dividend looks safe. So if you like Microsoft for the dividend, who knows what they're going to be doing in the future. I like Compass Minerals a lot better. David asks about Bank of America again. Look at Endurance Holdings, ENH. It's up almost 10% since we added it to the multi-bag newsletter. Property and casualty insurance company. What I love about it is that it's some of the biggest insider buying you'll ever see. And so there's a better financial than Bank of America. Much smaller. Property and casualty insurance is the best kind of, most profitable kind of insurance, and the CEO is buying a lot of stocks. So it looks like a good one to me. James asks about lumber liquidators. They are awful stewards of capital. Running the operation, there's running the operation, and there's what you do with your profits, as we saw. They did huge buybacks at very high levels, and they did it while insiders were selling out, meaning they thought the buyback was kind of a questionable idea. And there's even some companies, who knows, they might even do a buyback so the insiders can sell out at higher prices. So that stinks to high heck. Forget the 60 Minutes investigation that lumber liquidators is poisoning their customers. So maybe they're bad at operations, but they are bad at allocating capital, so stay away. I prefer BCC, Boise Cascade, if you're looking for something similarly sized. Lowe's, the big store. Excellent stewards of capital if you want to kind of be in wood with great capital allocation. Ansha asks about NUGT and DUST, Nugget and Dust. That's the 3 times daily gold miners or the 3 times daily inverse gold miners. Look at the long-term chart of both and steer clear. Gold has a place, and it's next to your guns, rice, and iodine for you preppers out there. Those 3 times inverse and 3 times gold, don't play with them because you got to get them right in the short term, and if you're going to short them, you got to get them right in the short term. Raj asks about NXP Semiconductor, NXPI. They just did a big merger with Freescale, FSL. The thing about big mergers, if you just watched our segment on management, big mergers are notoriously hard to integrate. 2 out of 3 don't work, depending on who you ask, where you get your numbers. Stocks that both of those stocks should be up on this news. They're probably up a lot right now on that news, but I would steer clear. Acquisitions generally, big mergers generally are problematic and don't work very well. Don asks about clean energy fuels, CLNE. They're up a lot. They just reported a good quarter. They've got T. Boone Pickens, and he's actually, whatever you maybe, oh, he just got lucky and he's rich. No, he's really smart, and the fact that he's there is actually a great thing. Clean energy fuels is not my cup of tea, but as a spec, you have my blessing. Looks okay to me. Kathleen asks about Micron, MU. Micron is getting cheap, but that's a watch out. Cheap is not good enough. Micron's getting cheap, but the insiders are doing more selling than buying. And I've learned the hard way that looking cheap is not a good reason to buy a stock. I'm thinking about Lantronix here. Instead of Micron, I'd rather you be an Apple or TelcoNet. I just can't get behind Micron. I don't hate Micron, can't get behind it. Douglas asks about Qualcomm. Here's another chip maker. They're a $120 billion chip maker. If things go wrong, they could fall a long, long way. So there's not enough upside there for this guy. And like Apple, they will never get credit for what they might do in the future. They're a device maker or a semiconductor, they make the chips. So that they're going to be a quarter-to-quarter story, and if you want a quarter-to-quarter story, go with Apple. But instead of going with Apple, check out Intricon, IIN, or Sierra Monitor, SRMC. Those both have multi-bag upside in replace of Micron or Qualcomm. Check out Intricon and Sierra Monitor. Okay, because there's two stocks that Warren Buffett could never buy because they're much too small. Okay, Chandra asks about eyes, Second Sight medical products from the great Dr. Alfred Mann, huge philanthropist, billionaire, one of the most successful people. If you've never heard of him, it's like amazing he's not more famous. To me, it's amazing he's not more famous. We first wrote about Second Sight a couple of years ago when we wrote about Mankind. It's had a huge move, but if you like it and you have a long time horizon, I'll definitely give you my blessing because it's Dr. Mann. He's had so many massive successes, huge massive successes, very important things he's done. And the technology in the Second Sight is nothing less than miraculous. Blind people can see with bionic eyes, and it's real. Okay, Matt asks about SanDisk. SanDisk is, again, another perpetual quarter-to-quarter story with a lot of eyes on it. If you want something like that, go with Apple, in my opinion. But again, Telconet, Intricon, Sierra Monitor, there's three companies with a lot of upside that Warren Buffett could never buy, and that I would definitely recommend more than any of those semiconductor makers. Here's another semiconductor, Intel. Lucas asks about Intel. I actually kind of like Intel if it comes to Micron or Qualcomm or SanDisk. I actually like Intel. They're just a very well-managed company. The dividend is safe. Again, Telconet, Intricon, Sierra Monitor if you want upside. But as far as large stocks go, and if you're asking about the dividend, Intel is a well-managed company, it's a good company, and so they're sort of an industry titan. And even though that Warren Buffett can buy them, I still kind of like them anyway. Ronnie asks about Garmin, GRMN. They've got a great balance sheet and a healthy dividend. They're already discovered, so I don't mind them so much. But again, Intricon is a little device maker, a little handheld body device maker, getting the medical fields, things like that. Sort of like what Garmin is doing, getting the athletic stuff. So Intricon is sort of like an undiscovered company like that. Ernie asks about UNG, natural gas. If you watched my 5 things to look for in the economy going forward, cheap energy is one of them. I'm not going to be able to guess what natural gas is going to do on a day-to-day basis. And so UNG, it could have a short-term move higher. Generally speaking, I like energy to stay low. But I would steer clear of trying to guess the short-term moves in energy. If you want an energy efficiency name, Telconet. Zachary asks an interesting one, Splunk, S-P-L-K. It's interesting, and I'm not really a bear on the name, but they don't make money, and the CEO is selling millions of dollars worth, and so you know what that means. We have to steer clear. Elliot asks about Alcoa, the aluminum maker Alcoa. If you want to be in this space, I much prefer Carpenter Technologies, CRS. CarTech has less commodity exposure. It's being more specialized in mission-critical components. CarTech is going through a rough patch. It has sold off quite a bit, and I think this is a great time to buy a piece of a great American business. Plus, CarTech is from my hometown of Reading, Pennsylvania. Okay. All right, so that was the thunder angle. Jim Cramer does the lightning round. That's capricious and arbitrary, but we have the thunder angle. All right, I hope you found that helpful. I'm Joe Springer, helping you make informed decisions so you can succeed in the market.